So thank you, Clemens, for the presentation. I think the report, as I said, is now available. So to download and to read it at your own time, it's available on our website, and there's a QR code. I don't know whether it can come. Let's see. I don't know how to get it on the screen, but my colleague will assist us with that so that we can be able to download it and read it at your own time. At this juncture, I would like to invite the panelists to come and join me up front here and join Clemens. So we have, as I said, very seasoned panelists in this space. Samia Nani, she's the Chief Credit Officer for Africa Invest. Please join. Constantine Kandie, MIDA Advisors. Dolu Olbenjo, Stanbic IPTC. And Juan Pablo de Molin, Senior Investment Officer at the AFSIC. Why don't you just move up one more? Okay, yeah, you can have. Yeah, so welcome, panelists. I'd like to start the conversation with Samia. Africa Invest has been in this space for the last 8 years. Maybe you can tell us how different your approach is to bank lending. And then, of course, you can also tell us the experience. The perception of risk, credit risk is very high in Africa. What has been your experience as Africa Invest? And then finally, how do you solve the currency problem that is now very live, as Clemens mentioned? Yeah.
Thank you, Evans. First of all, I mean, private credit is a bit different from banks. I mean, banks, what they prefer is to have standard product offering to the companies. They need to have large portfolios, so they need to offer something standard to all the companies. They will start first by asking about collateral, which I understand because they want to have secured financing. And so either the company manage with that terms, or they will collapse and maybe go into default. Private credit is not a business where you offer standard term sheets. You have to offer tailor-made solutions to the companies, and that's absolutely essential. So our first question would be, what's your business? Understand what the business is, how the company is managing to generate the cash flows, and then maybe we ask the question about security. And security, we can also offer some innovative solutions for securities to make sure that we are protecting also our stakeholders. The other thing, and because we were involved in the last 10 years, almost 10 years in SME financings, SMEs are also not sophisticated. And they need a lot of assistance, and we need to help them to use the financing for a successful growth strategy. So there is a lot, I would say it's a very high-touch business. You need to assist the promoters to implement ERPs, to think about ENS, to organize their governance. And it's a win-win. So you spend a lot of time with these companies, but it's a win-win at the end, because this is how you make sure that you can get back your financing as well and on time. So compared to banks, we need the banks. We are complementing the banks. Yeah. But when you think about SMEs, when they want to grow, when they need tailor-made solutions, private credit is part of the solution, especially when you think that World Bank reported $330 billion financing gap for the SMEs in Africa. So there is definitely a good position for private credit. Regarding the default, I would say pre-COVID, from our side, it was extremely low. Not to say in December we were at 0% NPL. COVID hit, unfortunately, and it's not only COVID but geopolitics. And the role of private credit is also to be a little bit patient. Of course, you have two conditions to be patient: that you trust the promoter first, and second, that you believe that the business can make it and survive. So at least you can maybe restructure and help the company to go again through this challenge or unexpected challenge that all the companies are living currently. And Evans, you asked me also about foreign currency. Indeed, most of the private credit is now in foreign currency, which is, of course, a challenge also for the SMEs. So the way we do it is, first of all, of course, we are interested, our preference is to go to companies that have the natural hedge. And when you say natural hedge, the obvious one is the export. The second possibility is when they are importing also part of their raw material, when they can pass on that devaluation risk to the final customer. But of course, it's not ideal. We need to keep in mind also that when you finance companies in foreign currency, the interest rate is not the same. So there is still some room for devaluation that the company can absorb. And finally, also, some companies have such nice high growth, like double-digit growth. They are also happy to take that risk because they can accelerate their growth by having the proper financing to do so. But at the same time, and which is great, is that we are seeing many local currency initiatives, and we hope that it will be more in the future, because that's in the best interest of the SMEs. Thank you.
Thank you, Samian. I want to turn now to Dolu. You've raised about $50 million from local investors in Nigeria for your infrastructure fund. What do you see as the opportunities for private debt in Africa? I know there are no challenges, so don't focus on the challenges. What do you see as the opportunities for this asset class in the continent?
Thank you very much, Evan. I think once you can look past the challenges, and there are some, the opportunities are quite vast. Within the infrastructure or alternative asset class construct, there is a lot of need in terms of where you can deploy capital. And what we found is that we're actually solving real problems, in the sense that I haven't heard the clamors of sponsors. You don't have long-term capital. You don't have capital that is structured to actually tailor-made to actually provide the right solutions. What the private debt space provides is to sort of an answer to those problems. And the opportunities are there, because I'll take our fund, for example, launched in 2021. By the end of this year, we will have delivered total returns of about low 20s to our investors. And that is because you've listened to the real opportunities that, or the real requirement that the investors or the sponsors have desired, for which you are providing a solution. I think beyond that, if you just look at the landscape, there's a need everywhere. Every sphere, every sector you turn around across the continent, there's a need, whether it's in logistics, whether it's in energy, whether it's in education, and it's a matter of changing the mindset in terms of investors being very patient. And once you can pretty much understand that this is not a rush, it's not a sprint, it's a marathon, then you're able to navigate all the hurdles, and there are quite a number of hurdles. I think the last point I would make is in the mindset of collaboration. You don't look into the continent and think you can do it alone. You need to be open-minded. I feel that when it comes to infrastructure as a general theme, the status of the ecosystem now is one of collaboration as opposed to competition. And all stakeholders need to speak the same, sing the same tune to the PFAs, to the pension guys who are quite conservative and who need to be handheld to release some of this capital that we all desire. In the context of Nigeria, there's about $35 billion sitting in PFAs, and as was said earlier, all of that is going into government security. How do you make an appeal to them to give you some of that and to test it out? And that's what we've started doing, and it's showing up with results.
Yeah.
And I think once we're able to demonstrate that, which we've started, the PFAs would open up, and we can then begin to solve real problem at its scale, the scale that is desirable. Yeah, thanks.
Yeah, thank you, Dolo. So, John, I want to turn to you. As Clemens presented, the DFIs have been very instrumental in growing this asset class over the last 5 years. About $37 billion has come into Africa. About 30 billion of that has been through DFIs, such as the IFC. Of course, there's been some criticism, whether you are crowding out local investors. Do you feel that DFI is actually playing a developmental role in this market? And two, how can you work much more closely with the private sector investors, including domestic institutional investors in Africa, to grow this asset class and get the right mix of instruments and financing going into the real and social sectors in the continent?
No, thank you so much. So let me start with the most important point, as you mentioned, which is crowding out. So if we look at, and just considering what happened in the last 24 months or 36 months after COVID, if you were asking me this question maybe before that, I would say maybe there is a path to think that in some markets, some sectors, DFIs in general were crowding out or pushing out, in most cases, alternative solutions for financing. Not to say that COVID changed the game, but it's a new game, particularly in areas that require significant investment opportunities. So I think I piggyback on the last comment. Collaboration is more appropriate, I believe, at this stage. The financing needs and looking forward, just not what COVID provided in terms of macro changes, but also the consequences of what we're seeing in terms of the financing infrastructure across markets, and not just pointing out that simply rising interest rates. There is a relevant point that we can make at this stage on not only trying to collaborate more on the traditional financing, but institutions like AFSIC were trying to do more of in two fronts, particularly, which are a significant gap at the moment. One is the local currency front, and the other one is on the private sector, on the debt side. Just to point one single number, just to give the idea on. So we have been trying, for example, in the last fiscal year, up to June of this year, we have increased, and our total, globally speaking, our total commitments and investments in local currency have reached finally our 35% of the total investments we have done across the world. And in Africa, that translates into around $500 million or so in local currency equivalent. If you were looking just a couple years backwards, this is more than 40% of what we were doing at that time. But still, it's a small number.
Yeah.
Looking at the gaps, looking at what we need to do. So collaboration comes in different ways. It's not just a simple word. We're investing directly, but we're also collaborating. We're investing in funds. We're investing in platforms in ways that can allow us to reach sectors or segments that we're not able to do so.
Okay.
So there's, we can be on the big tickets. Everybody knows that, and we have the ability to help issuers, borrowers, and clients across these markets. But the reality is we also need to help the smaller ones, the sectors that requires much more in-depth knowledge and ability to scale at that level. And we are doing that as well. And that's one of the goals we have going forward on the alternative scheme on the private sector. And the last point you mentioned is what can we do more of to do this? Effectively, it's just expanding the view and expanding the sectors that we cover. Traditionally, we've been being truthful to our charter. We have been trying on the social, but there's many definitions today of the sectors that requires us. It's not renewable energy only, it's not the social impact. We're trying to make an effort. There was mentioned earlier today on the SME space. That has many ramifications. So there are multiple ways in which we are continuing to do development directly in the sectors that everybody is familiar and the gaps, but also indirectly through many other venues. Helping out SMEs and SME institutions and facilities directly tackles multiple issues. We tackle help on the social space, we tackle climate, we tackle financial inclusion, and inclusion, for example, of more women in the investment side. Just focusing on SME and SMEs.
So Joan, if I may ask a follow-up question on that. So sectors, yes, new sectors, doing much more there. But what about working with the local institutional investors? As we know in Africa now, we probably have $1 trillion of assets under management in local currency. How can we work a bit more with those kind of entities?
There's two ways we're doing it. One is, of course, directly, trying to engage, trying to do more of. But we're doing more and more, and many clients and many people probably in this room are familiar. We are trying to help, for example, to the risk, helping local institutions to do more of. More of, not all of the time is just funding, is providing access to the risking tools, providing guarantees. That's a space we have been focusing significantly more, and we will continue to do so. That's a way to free up capital. That's a way to allow institutions to tackle and absorb more risk. And we are in that process as well, just not just with the funding arm, but we're also on the risking and helping with capital.
Yeah, thank you very much. And that's a very nice way to Constantine. You've been involved with the Kenya Pension Funds Consortium. I believe you have 27 members. What has been your experience encouraging your members to consider alternative investments such as the private debt? And Joan has mentioned about the role of credit enhancements or guarantees. Do you think they play a big role in encouraging your members to consider alternative assets such as private debt?
Thank you very much. So I'd like to speak about my involvement in the formation of the Kenya Pension Fund Investment Consortium in 2017. I have been a trustee for the last 9 years, first with the Kenya Revenue Authority, and after that with the Moi Teaching and Referral Hospital in Kenya. And we came up as trustees and decided that we needed to collaborate and form a consortium so that we could co-invest into various projects, especially infrastructure, including housing as well. And later on, we also expanded to include all alternative investment classes, and that is where we come into PEs and venture capital. Now, the motivation to form KEPFIC was because we realized that in Kenya especially, pensions are quite fragmented, over 1,800 or something like that. So the big five was the original consortium, both from private sector and government. So we have banks as part of our pension scheme. We have the big government parastatals, central bank, RBA, KRA, but also private sector companies like Safaricom, Barclays, Standard Bank. So at the end of the day, we also then were asked by the regulator to open up and to include all pensions. So now, any pension fund in Kenya is free to join KEPFIC. Now, what was interesting about our formation of KEPFIC was because this was a consortium that was formed and led by trustees, it was very interesting and different because previously and professionally, the fund managers and investment managers own the space that determines what you invest in. But we realized sitting in the boardrooms that we were able to see the benefit of co-investment. How much more can we do together rather than working individually and investing in, as you know, those who may know the Kenya landscape, each pension fund has got a small building tucked away somewhere. that is overpriced, not having very good returns for the members, and all sorts of issues. So since we came together, it's been very, very good for us because we have now become the voice for the pension trustees in Kenya. Our membership, as you say, is now 27 and still growing. We have made joint investments already into 2 key projects in Kenya. One is the Akon Housing REITs, and the second one is a road in northern Kenya, referred to as the Lot 3 project, in which the pension sector was expected to contribute 20% of the investment into that project. And as we speak now, that particular project was oversubscribed by the pension sector several times over, anywhere between 6 and 10 times oversubscribed. So as it is now, it looks like, the allocators may have to rethink. And all those who say pensions are not interested, you can now recast your thoughts on that. We are very interested, but there are a couple of things we look at. One, and which was presented very well, thank you for the report from FST, is pension funds are private sector, and they want good returns for their investments. It's all well and good to talk about, focus on women, focus on SMEs. What else? What are the other buzzwords?
Climate, yeah.
All those are good to have, but at the end of the day, in Kenya, and I believe across the world, pension trustees have a fiduciary responsibility to their members, who I always dare say, my own grandmother's pension is up for discussion. I want her to be saying the right prayers to God, right? So we believe, and we have seen, especially with some of the PEs that have made presentations to our boardrooms, they do not know how to speak to pension trustees. They make a way better presentation to the bankers, right? But we actually need that level of preparation to make presentation to trustees. So be well focused, understand our motivation is to make money. Our motivation is to protect the investments of our members. And for example, with the Lot 3 project that I mentioned, Garantco provided a guarantee. A second benefit that has come to us as a result of coming together is KEPFIC now has the support of various DFIs and partners who are supporting our secretariat. We have the World Bank, USAID, FSD, MIDA. All these organizations and government, actually, have come together because we now are working together. They actually have given us a seat at the table. So now we have a voice.
So, Constantine, how much money do you have allocated to alternative investments, like a private debt? How big are your checks?
So, because of the work of KEPFIC, the Kenya pension sector is worth about 1.3 billion set aside for investment into alternatives. The whole sector is worth about 13 billion in Kenya today. Amongst our membership of 27, we have 4.3 billion available. And what we have also done is to actually have joint assessment, which saves everybody money. But more importantly, I think now PEs can be able to make presentations in the boardroom. I know there's been some barriers to that accessibility, but through KEPFIC, you are able to face the fund owners directly.
So you are now open for business in this space. That's a message I take away from that,
Yes, we are open for business. And again, with the work that I do with MIDA, we now work across different countries, pushing this consortium model and co-investment and collaboration. And let me just say one more thing on co-investment, is that the local pension trustees are very comfortable in co-investing with foreign investors. In fact, it gives them a lot of peace of mind and security, and also protection from what they may view as political risk.
Yeah.
Foreign investors, on the other hand, are very comfortable working with local investors because they get asked, you know, why would you invest in that country if the local pensions are not investing? So it works as a win-win.
That's a very good one, Constantine. Clemens, I think at the end of the presentation, you mentioned about the global challenges. I think since the report was completed, the war in Ukraine broke out. We've had a dislocation in the global financial markets. Is this asset class still attractive in the context of Africa, given all those challenges? And I think anyone else can comment on that.
Well, I think wherever there's a need for capital, there is a reason to go and try and figure out a solution to provide it. So I have no concerns whatsoever about the attractiveness of the asset class. Private credit is fundamental to the growth of any economy, and unless we're giving up on that, we will need private credit. But I think Konstantin made some very important points here about understanding what drives people to do what they do. As a banker for most of my life, I do know that all else being equal, you'd rather make money doing less work than doing more work. And so, we need to understand what drives people and what incentivizes them. And good words, for the most part, are not enough. So, there are two ways you get people to do what they don't want to do naturally. One is you force them to, and that could be by mandating that pension funds allocate a certain percentage of their assets to infrastructure investments, for example. The other way is to create a fear of missing out, which is showing them that other people can make more money than they do. Right? And so everybody has a role to play. We try to demonstrate that there is money to be made in ways they haven't considered, hoping that they follow at some point. And regulators have to see whether they can use regulation and basically mandates to the effect of redirecting capital. And everything else is important and plays a role, but if we can't get people excited about allocating money to asset classes, then it is very difficult to make a difference on the grand scheme of things.
Okay. So thank you very much for that. I think we have a couple of minutes for any questions that we may have, and I'm sure the panelists will be very able to respond to those questions. And I don't know whether we also have any questions on Slido. We can also have maybe one of my colleagues taking us through that. But I don't know who wants to go first with any question or any comment or observation. If there is none, I might use my liberty to point my finger randomly across the room. But is there anyone who wants to go first? Yeah, please. Could you get maybe a mic, if possible? I don't know whether there's a mic going around.
My name is Elizabeth Uwaifu. I'm a lawyer, a finance lawyer, and I was just interested in finding out, maybe from Constantine, in which African countries would you be investing? Is it just Kenya, or do you have an allocation outside of Kenya?
Is that directed to?
Maybe Constantine, I said, and then maybe in terms of capital. If anybody else that can answer that. Just interested in knowing what African countries you'll be looking at.
Okay,
are you allowed to invest outside Kenya as pension funds?
Yes, we are allowed to invest out of Kenya as pension funds.
What is
there is an allocation of up to, I think it's 5%.
15%? No, 15%.
5 or 15.
Yeah,
I'm not so sure. But the actual allocation is way lower than that, primarily because of some of the factors in the FSD report, including the attractive returns we get from treasury bills. But yes, the allocation, we are allowed. But we also, like I said, because of media work across Africa, so different countries have different requirements. But at the moment, for example, investing into Kenya is a lot of funds from South Africa, for example. So there are some countries that are further advanced and others that are still learning. And I believe the co-investment and collaboration model will help onboard all the African countries to appreciate the need to be able to invest across borders.
Okay.
If I could also chip in. Yes, we can reinvest outside of Nigeria. The regulation allows us to invest about 40% of our AUM outside of outside of Nigeria, and then the remaining 60% focus in Nigeria. I think the key thing, and this is what I say to my partners and colleagues, is that we have to first originate the right transaction. One of the things that we have to promise our investors is that we're matching the currency risk properly. Okay. So I kind of think about it that charity begins at home. If you can mobilize and galvanize local capital, it makes the construct of stepping outside of your boundaries into another country easier because you've demonstrated it internally. And then once you're able to do that, the PFAs are the ones that would actually lobby to allow more allocation into other countries. So the answer is yes, but it's a work in progress, I should say.
Okay, thank you. Please.
Thank you. I wanted to sort of ask the question from the side of the company that is seeking the finance. We pre-seed and seeded invested in a Nigerian business which is hitting its targets, doing well, sort of £1 billion a year turnover business or so now. But where is the front door to the products that you're talking about? So finding whether it's through private debt or other forms of development capital, it seems very difficult to take businesses from that seed stage into the sorts of customers that you're talking about here. I was wondering where you think the front door is for businesses that are looking for the products you've been discussing.
Samia, do you want to address that, or Clemens? Okay.
Yeah, maybe, I mean, to talk, I mean, we are more specialized in the SME side. And, I mean, obviously, with companies, when they look for financing, they go very often in Africa to transaction advisors that will try to translate the needs into the language of the funders. And you can find, I mean, many requests from venture debt to just capex financing, to working capital financing, or even, and it can be structured from different ways, senior secured when they have the security, ring-fenced, mezzanine. So you find many opportunities from SMEs or corporate looking for the private debt. And the reason why they would go, I mean, and usually, I mean, I would say, and this is also very important, promoters would like to think first about interest rate. What is the cheapest for them? And then you need really to take them through that route of understanding their interest in having the right structure for them, whatever the need is. I mean, it is venture or growth. To really make them understand the interest of having the right structure to reimburse when they have the capacity to do it, and to grow in a sound way.
Sorry, I think Clemens, very quick one. Yeah.
I mean, I think there's a very sort of simple rule of thumb for early stage businesses. Yeah, you should not finance your operating losses with debt, as much as that seems to be an attractive path because it avoids dilution. Yeah? So if you have productive assets that generate revenues in and of themselves, you can go and debt finance them. If you have startup costs, operating losses you need to cover, you need to find more equity.
Yeah, so thank you so much for that intervention. I don't know whether we have time for the one last question. Angela, maybe from Slido, any question? So we are good. So I think this is probably the end of it. We have exhausted our time. I think, as you can see, there's a lot to discuss. But I'm hoping that you'll get an opportunity to go through the report. It's now available. There is a QR code. If you don't see it here, we have a booth just across the hall. You can go there and get the QR code and enjoy the reading. And obviously, we look forward to finding ways of working together, to promote this asset class. So thank you very much for participating. I hope you'll now join me to thank the panelists who have done such an excellent job. Please.